what is the biggest and most important deadlines from EBA side that banks should be aware of?
I think the big date that is coming, and it's coming very soon, it's 11th of January 2026. We all should mark this date in the calendar. This is the date where the new capital requirements are becoming applicable by all banks. Trust me if I tell you that regulation has never worked so fast before. It's just around the corner, so get ready.
Welcome to this episode of The Hubble by Telescope. We are so lucky today to have the European Banking Authority as our guest. Very happy to have you here on The Hubble, Dorota. Welcome.
Thank you for the invitation. It's my pleasure to be here.
So we have a packed agenda today talking about climate risk and capital risks and the correlation between that. But could you start by telling us a little bit about who are you and your background?
Yes, of course. Thank you. So the European Banking Authority is an EU agency, an independent EU authority that was created after the last financial crisis to safeguard the integrity and soundness of the EU banking sector and to support the financial stability in the EU. So just to clarify in here that the EBA does not have any supervisory powers over the European banks, but rather we are providing guidelines and technical standards that are to be applied both by banks and by the supervisors across the EU. So that's briefly about the EBA. And me, I started with the EBA 12 years ago, back in 2014. When I started, the ESG topic was not yet on the agenda. So my first area of focus was credit risk, and in particular, internal models for credit risk. Then I moved to the area related to the supervisory processes, and I was working on the guidelines for supervisors. And then finally, from the beginning of 2022, I have a pleasure to be a head of ESG Risks unit that in the meantime was created at the EBA. Before the EBA, I was working a bit for the commercial banks, both the big ones and the small ones. And I also had an episode in one of the supervisory authorities. So all this experience, both at the EBA and before that, is now very helpful in my job and tasks as the head of ESG Risks unit, because here we are trying to incorporate ESG aspects and considerations across the various aspects of the framework for banks and indeed the understanding of how banks work and how supervisors work is very helpful in this process.
Excellent. So let's just start a little bit about why the EBA has its own dedicated ESG risk unit.
So the unit was created in 2021. The work on these topics started a little bit earlier within the previously existing structures. But around that time, it became evident that ESG is the next big thing in the banking sector. And it was then necessary to create this specific structure to make sure that we will be addressing this topic in a way that is consistent across the various elements, and to make sure that we will have this holistic view and holistic approach to this topic. So that's why the decision was taken to create the specific unit to look at these things that were to a large extent new to all of us. But it's fair to say that because our strategy is really not to create something on the side specifically for ESG, but rather to embed this ESG related thinking and considerations across the existing elements of the framework. So our ultimate success will be once we are no longer needed, in fact, when everything will be just working smoothly as part of the normal ongoing work, both on the side of the banks and the supervisors.
And then we're touching a little bit into the topics of the day as well, because we want to talk about capital and climate risks. And in an ideal, perfect world, how should climate and capital risk management correlate?
So, in principle, the capital is supposed to reflect the riskiness of the bank's activities, and in particular, the lending and investment activities. So this is what we call a risk-based approach. And we are trying to design the framework in the way that exactly the level of capital that the banks are required to hold should correspond to the extent of risks that this bank is taking. But of course, the world is much too complex for the prudential framework to be able to reflect all that. Therefore, to some extent, simplifications are needed. But specifically from the perspective of the credit risk, which I think the one that is attracting the most focus in the context of ESG as well, is the perspective of the counterparty. So how risky are the borrowers that the banks are lending to? But then also, what is the potential to recover the debt in case it's needed in case of default of a counterparty? So this is the main perspective of how to assess the riskiness of exposures.
Mm. And in this process, what do you think, or what does the EBA find as the biggest bottlenecks and the challenges?
So this is still a new process, and here a disclaimer like this, that it's not that I want to criticize anybody right now, but just to recognize that the development in these kind of areas naturally need to take time, and this is there are progressive improvements. But so far, the efforts naturally have been focused on identifying the exposures that are actually subject to these risks, to climate risk and broader ESG risks. And this has been done mostly through identification of exposures to specific industry sectors that are considered to be the ones highly contributing to climate change, or those that are particularly polluting, or identification of exposures in specific geographical locations which are prone to specific physical risk hazards. So this is mostly focused on identification of exposures that might be subject to these risks. But this is not yet telling us to what extent these exposures be affected by these risks, right? So this is the second step that must follow, and this is where we still observe significant challenges. So in order to be able to really assess to what extent the ESG risks affect, for example, the credit risk, we would need to put the climate or ESG factors in the perspective of the traditional financial measures of the financial performance of the counterparties, like profitability, assets, leverage. But these are affected by many various elements, and not only just ESG factors, right? So this is becoming very complicated, and that's why it is still challenging to figure out how all these elements interact. And on top of that, we would also need to know how climate risks potentially interact with broader economic conditions, or in particular with economic downturn or even recession. Is this affecting the way also the specific counterparties are affected by the climate risk? So this is the area where further developments are definitely needed, and there are still some challenges on all sides on that front. And here, just to flag what is the challenge in the prudential framework, is that it is not even certain whether the high emitting companies, for example, will bring more risk to the bank than the green ones or the sustainable companies, right? Because in many cases, it is actually the other way around. And you might observe that the high emitting companies are often the ones with very good financial standing, with good credit records, with very diversified activities, with very comfortable capital buffers. So these are companies that are exposed to, in particular, transition risks, but are not necessarily as risky for the banks from the perspective of credit risk. Now, on the other hand, the green companies that engage in sustainable activities, green activities, they are very often startups with no credit history at all, or based on some technologies that have not yet been tested sufficiently. And these are actually the ones that face much higher probability of failure in the short term than the polluting companies. So this picture here is quite complicated, and that's also why we need to be cautious, both on the side of banks and the regulators and the supervisors with this, because on the one hand, we want to support the transition and we want to encourage investment in green and transition activities. But on the other hand, we also have to make sure that the risks are still under control and that the risks are within the specified levels of risk appetite by banks. So this is where we need to really pay attention.
No, I completely see that. And coming from a company that is a startup as well, it's like there are so many uncertainties with regards to, cash flow and securing the economic sustainability of that company before you can even enter into discussions with banks as a viable financing source. And if you look at the technological maturity of many of the green disruptive transitional startups, like working with hydrogen, for instance, or carbon CO2 capture, for instance, the technological maturity is simply not there to have a financial viable model financed by debt, essentially.
Indeed. So I completely agree with you. So these transition processes, they bring a lot of opportunities for the businesses and for the banks as well, but they also bring additional risks, and these have to be taken into consideration as well, especially by the prudential regulators, because our job is really to safeguard the financial stability. So we need to pay attention to this.
Absolutely. But if we look at other asset classes, such as real estate, which is an obvious one that we are working with here in Telescope, in real estate, things are a little bit more mature when it comes to technologies. What do you see there with regards to the current practices of green assets versus brown assets and the riskiness of those different classes?
So the real estate exposures, this is indeed the area where also banks have significant expertise already now, and to some extent, even before the ESG topic came up as a big thing or as a separate topic, many of these aspects that we are discussing right now have already been taken into account in certain credit processes. So the kind of impacts or dependencies on certain aspects or the risks related to some policy decisions or activist actions in certain projects, they have always been taken into account, because this is part of the business, and of course banks would also need to take that into account to be able to properly price the exposure. So, like I said, to some extent, this expertise already exists and have already been incorporated. Now, what is changing right now is that this is being done in a more systematic way and isolated, identified a little bit better, so that it can also be compared across the various portfolios, various activities, or various banks or projects, right? And also from the regulatory side, there has been more attention to this aspect. There is a requirement that exists already since 2021. So in this world, this is already a long time. So this was one of the first requirements that was incorporated, that banks in their credit processes, when they use the valuations for collateral, and in particular immovable property collateral, they need to make sure that these valuations take into account considerations about ESG risks. So this already exists. Banks have already incorporated this requirements is already quite a few years. And it is actually even reinforced in the in the most recent regulatory developments were based on the recently revised capital requirements. The collateral valuations that are taken into account in the calculation of capital requirements, they can only be taken into account if they reflect the ESG risks considerations. So this is, I think, a very strong reinforcement of the need to take these risks on board, and this is an incentive both for the banks to think about these risks in a more structured way, but also for the valuators to make sure that the valuations that they are providing to banks meet the requirements of the current regulations.
What may be the consequences if a bank, let's say, does not factor into or if the collateral value does not reflect ESG risk at all, and the bank does not follow up on this, if you get what I mean?
So there's, of course, business consequences for the bank itself, because if the bank fails to take into account these risks, then they may not be pricing the risk properly in their business processes. But there might be also consequences from the supervisory or regulatory perspective. So they might face consequences or recommendations or even fines by their supervisors for not complying with the applicable law. But in the calculation of the capital requirements, I mentioned that technically these valuations that do not reflect ESG considerations will not be able to be taken into account and reflected, so that they will not be decreasing the capital requirements. But from the practical perspective, I think that banks will still be able to apply their own adjustments to account for this gap and still be able to use this valuation in the capital calculation, but after specific, I understand, downward adjustment.
Okay, and now we're touching a little bit onto like how the banks are calculating their capital requirements and a little bit into the pillar defense system as well. Could you start by explaining a little bit on the pillar defense system in itself, what it is, and then we can try to break down the different tiers in short?
I'll try to be brief, because the system of capital stack is quite complicated, or it seems quite complicated, but well, each of these elements has a justification and has a specific purpose, right? So I'll try to present it in a way that is simplified, maybe not taking into account all the little details. But I think that important to understand is that the capital requirements are calculated based on the accounting values. So the accounting framework itself is already, in fact, the first level of these safeguards. Because the accounting framework already reflects what we call expected losses. So any losses that are, reasonably expect to happen in the near future are already treated by accounting as if they have already happened. So they already decrease the exposure values. And we take these already decreased exposure values as a basis for the calculation of capital requirements. So the capital requirement, in order not to double count what is already reflected in the accounting through impairment write-offs, is only looking at the so-called unexpected losses. So the unexpected losses are those that are still possible that they will happen with a certain probability, but they are not deducted from the exposure values based on impairments. So Pillar 1 requirement is taking the standardized view on this on these unexpected losses and provides the uniform formulas for calculating risk weights for each of the exposures to come up with the requirements covering credit, market, and operational risk. Right? So this is okay. It's a very uniform, standardized, harmonized way to calculate, and all the banks are using the same way of calculating the minimum requirements. So this is also ensuring the minimum level playing field. But then clearly this minimum requirement is not covering everything. And in order to cover those additional risks that are not captured under Pillar 1, and also to reflect some individual elements of the business models of specific banks, there is a Pillar 2 requirement that is not unified in the same way as Pillar 1, but these are individual decisions taken by supervisors on individual banks to address specific risks that are faced by these banks and that are not covered by Pillar 1. And then on top of that come the macroprudential buffers. And the macroprudential buffers are supposed to capture the systemic risks, right? So this is something that is not specific to individual banks, but then the macroprudential buffers are supposed to safeguard the financial system as a whole for the aspects that are, systemic in this space. There is Pillar 3 as well, but just to clarify in here that Pillar 3 of the prudential framework does not bring any additional capital requirements. Pillar 3 is an element of transparency and market discipline. So here, banks are required to disclose the risks that they are facing and what they are doing with it. And in this way, it incentivizes the banks to manage these risks properly so that, they look good in the public disclosures.
Yeah, makes sense. And also the pillar that kind of enforces them to showcase how ESG factors, for instance, are reflected in collateral valuations.
Indeed.
Excellent. A little bit curious about what you mentioned about the macro-prudential buffers to capture systemic risk. Is this where, for instance, physical climate risk events and extreme weather events are factored in?
So this is still an open question.
Yeah.
So at this stage, the efforts that have been done so far are rather incorporating both physical and transition risks, rather in the microprudential elements of the framework. So rather, they are assessed specifically for each bank and by each bank. Now, that said, the recent review of the capital requirements regulation and directive brings a change that is recognizing an explicit possibility for the macroprudential authorities to use the systemic risk buffer to address climate risk. So this is something that was not explicitly mentioned before. It was included in the revised version of the banking package right now. And so right now the macroprudential authorities in each country, so these are the decisions that are not unified at the EU level, but these are possibilities for the national authorities to set specific systemic risk buffers at a national level. And that is subject to recognition in other countries. So it's a complicated framework, but that's how it works. And now the macroprudential authorities have a possibility to use this buffer for this particular purpose to address climate risk. Now, this is still a new element. So far, we have not had yet any examples of any of the authorities actually doing that. These requirements actually this new framework becomes applicable only from next year, in fact. But we will see in the coming years whether and to what extent this possibility will be used by certain authorities.
Because it's very interesting topic. Like in Norway, for instance, you have every fall these flooding events they happen, and in one year in particular, you saw that the extent of the flooding and the damages related to the floods in the fall caused the state-backed nature damage fund to be emptied for that particular year, and some of the insurance companies, they had to go to the stock market and raise more equity to be sufficiently capitalized. And that is also some of the trends that we're seeing across Europe and on both sides of the Atlantic, that the pressure on insurance with regards to physical climate risk particularly, is growing very much and has done so in the last 20 years. And when we talk to guests here on the Hubble, for instance, especially from banking, many are leaning on insurance company as coverage for their, or as securitization for the collateral value. What is your perspective on this growing insurance gap?
This is indeed a growing concern, also across the policymakers. So that is true that there are new dynamics that are taking place. This is the area where more analytical work is needed at this stage to understand better what's happening and what are the potential consequences of this, where this is all heading. But it is indeed a growing concern that at least in some regions, the insurance premiums might reach the levels that are unaffordable by the potential users, or in even more extreme cases, insurance might become unavailable in certain areas at all, because it will be just too risky for the insurers to provide that kind of tool. So it is a growing concern, and there is a lot of attention put on that by the policymakers as well. On our side, we are in contact with our colleagues from EIOPA. So EIOPA, for those of the listeners who might not be familiar with it, it's also an EU agency, very similar to the EBA, but that is focused on the insurance sector. So we are cooperating with EIOPA on the aspects related to the overall financial market, financial sector matters. But just to flag in here that from the perspective of the whole financial system, the insurance is not necessarily a mitigating factor, right? So insurance is a mitigating factor for banks because they are putting the risk away from their balance sheets. But this risk is not disappearing. It's just, being moved from one pocket to another. So from the perspective of the whole financial system, it has to be addressed in the holistic way. We don't have a solution just yet, but it is definitely on the radar. And like I said, the starting point is really the need to understand better what's happening and where this might lead us.
Absolutely. Very interesting. Just to zoom out a little bit and look at sustainability and ESG and regulation that has happened across this last 5-year period. Many of the guests that we have had on the Hubble are pointing to instability from the regulator side and from authorities as a bottleneck to work continuously with sustainability. And from someone that is representing the EBA, how do you feel working in this environment where there's been a little bit back and forth from the EU side?
Yes, indeed. So we hear that a lot, I have to say, and I think that maybe as a starting point here, it's important to understand that there are two different dimensions and two different objectives of the regulations in the area of sustainable finance. So on the one hand side, we have the regulations that are focused on the prudential aspects and on the need to ensure the resilience of the EU financial sector against the ESG risks. And this is where the EBA is particularly active because this is in line with our mission to safeguard financial stability. And I think that in this space, the regulatory developments were actually quite cautious and balanced, and they were implemented in a sequential way without significant surprises for the market participants. So I think that, on this part of the story, I don't think that there is much reason to complain. On the other hand, we have another objective of the sustainable finance regulation, and this is the support for the transition of the economy to more sustainable state. And here, this is all the initiatives that encourage more sustainable finance, more transition finance, and support these kind of initiatives. And within this broad spectrum of initiatives, you can count the taxonomy regulation, which is putting up criteria of what is sustainable, what is not, the corporate sustainability reporting and the due diligence requirements. And all of these are right now subject to revision, right? Based on the so-called omnibus proposal. And I think that, the complaints about instability of regulation is probably mostly related to this aspect and this review that is underway at the moment. But here, what I would like to stress is that while I understand that this is challenging, and every change is always challenging, that is very clear, and I think that also on the side of regulators, it is well understood that that there's always a need for time to prepare to certain new requirements. But this particular change that is happening right now aims at reducing the administrative burden and aims at reducing the compliance costs. And these are the changes that were very much requested by the market participants. So, first requesting the changes and then complaining about the instability of the regulations is not really fair. So that's one observation. And I hope that, while of course it would have been better that, things were done right at once from the start, but this has always been a new area for all of us, including the policymakers. So these situations might happen. And at least I think it's a good signal that if certain, let's say, mistakes are spotted, then there's a will to actually correct that. And that's what's happening right now. And I would see that as a positive signal in general. But I hope that, these changes that are taking place right now will at least help one thing, that they will help to focus the attention on the really material aspects, the really material risks and impacts, and will help to address these in the first place. And I count on this as the main possible, good outcome of these changes that are taking place right now. And also on the side of data, and there's a lot of concerns on the side of banks, supervisors, but also policymakers, that the changes that are about to come at the moment are going to reduce the availability of data. And it is a concern. But at least I think the positive aspect of this is that we might shift the focus from the quantity of data to the quality of, we might have less data, but at least let's make sure that the quality of this information is better, because this is key to be able to actually effectively use this information for various purposes.
No, but a great answer, and many of our customers resonate really well with the last thing you mentioned here. Like some of the customers that we have here at Telescope are saying that the omnibus change enabled us to go for better content in what we were supposed to reporting, compared to only focusing on how to report, for instance, and the format and this data point over this data point, but the content of the actual data, and that made sense for their business operations is what many of them are focusing on right now. So I feel like that's pretty precise, at least to what we see in Telescope.
That's a very encouraging message. So I'm glad to hear that.
Excellent. So we are closing in on the end here, and for the concluding remarks, I would like to hear your take a little bit on going into 2026 now. What is the biggest and most important deadlines and happenings from EBA side that banks should be aware of?
So I would mention one, just to focus on the most important things. But I think the big date that is coming, and it's coming very soon, it's 11th of January 2026. And I think that we all should mark this date in the calendar, because this is the date where the new capital requirements are becoming applicable by all banks. These new revised capital requirements are actually already incorporating in a more explicit way the considerations about ESG risks. So this is important. And it's a very good signal also that these aspects are, now taken seriously and reflected in the capital requirements. But also, this is the same date when the EBA guidelines on ESG risk management are becoming applicable. These are the most comprehensive guidelines on this topic that we published. These guidelines were published in January this year, and they include also the aspects related to plans that banks are now required to develop to address ESG risks in the short, medium, and long term. So all these requirements, the CRR, CRD, the EBA guidelines, they are all becoming applicable from the 11th of January 2026. So this is right now the last stretch to make sure that everything is ready by then. And let's hope that this will indeed work this way.
Sounds amazing. So D-Day, 11th of January, that's something to look out for then. It's only 1.5 months until, so...
it's just around the corner, so get ready.
Get ready. Things are moving fast at EBA at least.
Oh yes, these last few years have been really intense, and trust me if I tell you that the regulation has never worked so fast before, I think, because always it takes many years for regulations to come up. But I think the area of ESG risks is an example where, when needed, even the policymakers can move fast.
Very glad to hear. Dorota, thank you so much for joining in on the Hubble. It was a pleasure talking to you, and hope to see you soon on the Hubble as well. We should do a catch-up after 11th of January.
Sure, that will be my pleasure. Thank you very much, and thank you again for the invitation.
All good. Have a good one. Bye.
Bye-bye.